In this episode, we will talk about index funds, and try to explain the advantage of investing in one. Without wasting any more time, let us go ahead. Index fund is nothing but a type of mutual fund whose portfolio of stocks and their weightage allocation is aligned to that of a market index. Since the allocation and weightage of both the index fund and market index is similar, the performance of index fund is aligned to the performance of the index that this fund is following.
But what exactly is a market index? And what is represented by its performance?
A stock market index is a measure that is used to represent the performance or mood of the market based on the performance of a few stocks. A sample of stocks based on the size of the company, market capitalization, or type of the industry are grouped together in different weightages to form an index. For example, let us look at the industry composition of the stocks that form Nifty 50, a popular market index of India. On the left-hand side, you can see the industries and their weightage based on the stock selected to represent Nifty 50, and on the right-hand side, you can see the companies whose stocks are part of this index. In the absence of market indices, one would have to evaluate the performance of all the stocks trading in a market to evaluate changes taking place in the market.
Okay. That explains what market indices are, but how are they calculated?
Before we understand how market indices are calculated, let us understand from the example of S&P 500 and DJIA, how stocks are selected to be part of an index. S&P 500 is an index published by Standard & Poor's and was launched on March 4, 1957. The index lists the largest 500 publicly traded companies by market capitalization in the U.S. and covers all major U.S. sectors. Whereas DJIA has existed for much longer and was launched on May 26, 1896. Initially, this index was started to track performance of 12 largest industrial companies, but today this index lists the 30 blue-chip publicly traded companies in the U.S. Like we saw, S&P 500 covers stocks from all the sectors, whereas DJIA covers the stocks from sectors other than transportation and utilities, since Dow Jones has special indices to cover those sectors. Now if we look at the selection criteria, companies whose stocks are part of S&P 500 should have market capitalization of greater than $9.8 billion. Those companies should have sufficient liquidity and financial viability. Percentage of floating share of such companies should not be less than 10%, and those stocks should contribute to achieving sector balance in the overall portfolio. On the other hand, DJIA constitutes of stocks of blue-chip companies, which have excellent reputation, and have shown sustained growth. These stocks should be of interest to a wider investor base, and contribute to sector balance in the portfolio of DJIA. That brings us back to our discussion, that how is the movement of stock prices is captured in these indices. Now, different indices can follow different methodology, but in one or other form those methodologies are similar to the methodologies used for calculation of S&P 500 and DJIA. Float market cap weighted methodology means that market capitalization based on the number of floating shares of each company, whose stocks are part of S&P is calculated, and weightage in the index is assigned according to float-adjusted market capitalization size of each company. Hence the larger a stock's float-adjusted market cap, the greater the impact a change in that stock's value will have on the index's value.
But what do you mean by floating shares and market capitalization?
Market capitalization is simply number of shares of a company, multiplied by share price. Float-adjusted market capitalization means that only floating shares will be considered for calculation of market cap. Floating shares are the shares, which are available in open market for public trading. Promoters or owners of a company might hold some shares which are not publicly traded, those kinds of shares will not be considered while defining weightage of stocks in calculation of S&P 500 index. Let us go through this example of 5 companies A, B, C, D and E which together form an index, and understand how the weightage for each company's stock is determined in the overall weightage of the index. You will notice that even though company D's stock price is not the highest, it has highest weightage because market capitalization of company D is highest among all. Similarly, company E has same number of stocks as that of company D but its weightage is lowest because the market capitalization of E is lowest, since the stock price of company E is very low. In the price-weighted methodology, price of each stock of the index is added, and then divided by the number of companies whose stocks are part of the index. In its simplest form, price-weighted index is nothing, but the average of stock prices of the companies included in the index. However, for most of the price-weighted indices, a divisor is used as denominator which has been adjusted over the years to accommodate for any changes in the list of stocks of the index, or any stock splits that might have happened over the years. While selecting stocks in a price-weighted index, Stock Selection Committee ensures that very high-priced stocks are not included in the index since higher the stock price, greater is the weightage of that stock in a price-weighted index. Let us look at the previous example of price-weighted index, to understand why and how divisor is changed to maintain the continuity of the index. We calculated the index value in previous example to be $16.60. Since this index is price-weighted, the number of stocks of each company does not have any impact on the weightage of each stock. But when the company C decides to split the stock, not only the number of stocks of company C become double, but its stock price also becomes half. To ensure that this split does not have any impact on the index value, the divisor is changed from 3 to 2.26. By making this change, index will continue to remain the same. Otherwise, it would have changed to $12.50, without any real change in the market and would have given wrong signal to index followers. Even though the stock selection, the number of stocks, and the weightage criteria is different between S&P 500 and Dow Jones. We can see from the historical graph here that the performance of both the indices has been closely correlated. Hence, we can say that these indices have been designed efficiently to truly represent the mood of the index.
Well, it is clear how indices do the stock selection and weightage assignment to each stock. And, it is also understood that this information of stocks included in an index and their weightage is publicly available, but that makes me wonder why do index fund exists, because anyone can make a portfolio aligned to an index with.
You are right that unlike other funds, where the fund manager has thousands of stocks to choose from, index fund must mostly stick to already defined stocks and weightage of the index, and for that reason these funds are called passive funds, and charge a lower fee, since these funds do not require as much engagement as active funds. Having said that, index fund manager has some key responsibilities. Number 1. Keep stock selection and weightage aligned to market index as stocks and their weightage can be changed by index committee in periodic reviews. Number 2. Index manager can take a call to keep up to 5% of the total funds in money market instruments or in cash, if he thinks index is not going to perform very well. And, number 3, minimize the tracking error. That is, to keep the performance of index fund as close to market index as possible.
But there are other mutual funds available, which try to beat the market index and not just provide the same return. Why should one invest in the index fund?
Index funds are mainly targeted at people who want to take advantage of investment in equities through mutual fund vehicle, but do not want to risk stock selection and weightage selection on the bias of fund manager. Performance of active mutual funds can be better or worse than index fund depending on market situation and volatility. Besides that, fee charged by index funds is also lower than fee charged by active funds.
Okay, that pretty sums up how index funds can add value to certain investors who do not want to, or cannot be actively engaged in the market. Hope our viewers will be able to take advantage of this video and find some good index funds to invest in. If you enjoyed this video, do not forget to press the like button and bell icon. To continue receiving more such informative videos about investment instruments, please subscribe this channel, all about investing. Thank you.